everyone. Good morning. Welcome to the Sensa Edge. I'm your host, Zoe from Sensa. Today, we are diving into the market phrase sell the news and explore how a long put strategy can help you profit in bearish conditions. So, we're going to talk about the strategy. We're going to talk about the latest news on why the strategy could be a good, especially in the bearish conditions, and then go from there. Before we jump in, I want to bring up in the previous podcast we spoke about politician trade, and one of the spotlight in Nancy Pelosi's recent trade, Tempest AI, has been really doing good. It's jumped up 50% since we spoke last. So I want to bring up the screen and then kind of see and what exactly happened here. I hope you can see my screen. And then if I go to sensor market and then jump into the politician trade, this is where we spent our time in the previous podcast. Nancy Pelosi's trade, which reported on January 17th. And then this particular trade on Tempest AI, the stock options of close to $50,000, $100,000 was bought. Then if I jump into this Tempest AI, uh, this again, Tempest AI, that's a company leveraging artificial intelligence in healthcare. According to Jan 17th report, Pelosi made this trade on January 14th. If you can see this here on January 14th, this trade was made. Since then, if you look at how it was trading somewhere around $32, and the report came out on January 17th. And then look at this particular stock, which is currently trading close to $50, close to a 50% jump or more. Again, whether you agree with the politician trade or not, there's no denying they often make some informed moves. So that's why Sensa Market, we want to make sure that we get all this real-time data and track all this particular trade. And we're going to use our podcast to talk about any of those interesting trades coming up. All right, back to today's topic. I'm gonna get my screen out here. Back to today's topic, sell the news and exploring how a long put strategy can help you profit in bearish condition. So today we'll discuss about the market's record high. Again, S&P hit 6,100 points, powering a mix of strong corporate earnings and President Trump ambitious $500 billion AI initiative Stargate. While the market celebrates, it's worth asking, could this rally be overextended? Historically, market rally on good news, but often pull back as the initial excitement kind of fades in. This is where the concept of sell the news comes in. And with SPY at this level, a long dated, like 2 years out, a put positions at a very low of $500 could be a strategic move. Again, we'll talk about that. I'm going to bring up my screen in a minute. Again, why could be this a good move? There could be a two potential condition, right? To hedge against the correction. If the SPY declines significantly over time, again, it could be economic challenge, geopolitical events, or a little bit of slowdown in earnings, your put option can increase the value. Again, more importantly, capitalizing on the future volatility. The volatility is low. Options thrive in high volatile environments. If the market gets choppy, the value of your option may rise even before the SPY reaches low as $500. Again, and why does this strategy make sense? The market is trending right now at record high and the valuations are stretched. A long dated put gives you time for a potential pullback, exposure to increased volatility, and an asymmetric risk reward setup. So while the market celebrates today's rally, savvy traders might already be in a position for tomorrow's uncertainty. Let's dive into those details of the strategy, why it could be a smart play for those expecting a change in the tide. The beauty of the strategy lies in simplicity. The risk is limited to the premium paid, but reward can be offering substantial high. Again, let's break this down, why the strategy works, how to structure it, and potential risk and rewards. Let's get into that. Gonna bring up my screen in a minute here. All right, hope you're able to see my screen. If I go to the option strategies, I can see all those 100 plus pre-built option strategy. It's as easy as pick any particular strategy, and then you can kind of like visualize your profit loss potential, and you can trade from it. So today, long put, and I have selected SPY already. SPY trading at 606 at this point. This is where the expiration date selection happens, and then I'm gonna go for a long dated expiration date as long as 2 years out to January 15th of 2027. And the strike price, long put, as the name tells, is you are buying a put position. So I'm gonna go to $500. I'm gonna adjust this range so we can actually see the profit loss potential. Um, Again, you might ask, like, why $500? The SPY is at 606. The $500 represents a bearish bet on a significant correction. Again, we are talking about 18% drop, which is plausible over the 2 years period, especially if the macro risk materializes. By leveraging this mispricing, a long put option becomes a powerful way to profit from the increased volatility and potential downside of S&P. While buying this puts outright may not usually be a best play. In this case, a straight up long put option could make sense. When we compare this implied volatility at this point of time, it's at implied volatility of 21.73. Again, you can see here the implied volatility 21%. You can also see the Greek's value here, delta, theta, gamma, vega, and rho for this particular strike prices. When volatility is low, buying options without hedging risk can be a smart move. Unlike high volatility markets, options tend to be overpriced. In this scenario, far out into the leaps, which is nothing but long-term anticipation securities, LEAPS, put options becomes powerful strategy. Again, why? It's essentially a bullish bet on volatility with the added benefit of downside protection. Right. Again, how it works again, two things to look, right? Delta, as the SPY drops, the value of your put increases based on the change price. Again, time value expansion, since it's a long dated, meaning they have significant time value, 2 years. If volatility increases, this time value can expand, further boosting the price of your put. Again, this strategy shines if you're bearish in the short or moderate term or expect market volatility to rise. Leaps puts us ideal because they have a high vega. If you can see the vega right here, it certainly has a high vega, meaning their value is more sensitive to change in volatility. In simpler terms, they let you profit from two things: either a market drop, and second, and the most important, a rise in the market uncertainty. Again, if you don't like this particular strategy, you can go. There's like straddles and strangles. I've changed the strategy here to straddles. Straddles is where you buy a call and buy a put for the same strike price, and you're not betting against any particular direction. Here, you will make profit if it is above a specific price or below a specific price. Again, the focus on capturing volatility without betting directionally. Right. Again, this is a long straddle. If you can short straddle, and then if I can jump into the strangles, and then you can actually like change any particular strategy. The difference between straddle and strangle, again, we'll deep dive this more in our upcoming podcast. But straddle is where we saw that both the strike prices has to be the same. You're like buying a call and buying a put at the same expiration date. But when you do a strangle, it is buying a put and buying a call at a higher price. Kind of gives you this particular strategy. Again, back to what we are talking about long put. Again, if you want to do a long put, you're bearish for it, especially for a long dated strategy. Let me go back and adjust this expiration date. We're looking at January 15, 2027, pretty much close to 2 years out. And then we're looking at $500 put position. So again, in this case, the net quote here is $17.50. So to enter this particular $17.50 multiplied by 100, so close to looking at $1,750 debit, but the profit is much more rewarding. Again, theoretically, the profit is much high, but what you're betting is two things, like I said, right? The market drop and a rise in market uncertainty. Again, to highlight in this particular thing, 3, bearish play with volatile exposure. A long put not only profits as SPY declines, but also benefit from the changes in the implied volatility. Again, extended time horizon, the leaps gives you longer window, 2 years down. See you as a bearish thesis materializes, reducing the pressure of the short-term market noise. Again, given that it's an asymmetrical returns, the debit to enter this particular position is the maximum loss you'll be having, but the profit is more rewarding than what it is. So in summary, the strategy leverages the market's low volatility and provides a flexible, high reward way to position for potential market downturns. All right. If you think you like this particular strategy, you can click on place order, and then you can connect your brokerage on Trade Your Brokerage and then execute the order right from the Sensa market. All right. So today's topic was how to take advantage of the assumption that implied volatility of SPY is too high and that we are about to sell the news moment. Next time on Sensa Edge, we'll dive into how double dividends on defensive stock and then talk about that more and also learn about more of the strategies. All right. Again, this is your host, Zoe. Thanks for watching. Be sure to subscribe, leave a review, and follow us on the platform. Thank you all. Happy trading.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.